Daily Market Report, September 4th, 2015. Main market movers of the day. Euro US dollar. The ECB surprised markets with a strong dovish stance this Thursday, sending the common currency to a fresh 2-week low against the greenback. Mario Draghi expressed officers' concerns over the economic slowdown that affects emerging countries and China. Additionally, the ECB staff downgraded its forecast for growth and inflation and increased the issue share limit to 33% from previous 25%. Somehow, the ECB has let investors know that QE is not working as well as he previously announced. In the US, weekly unemployment claims came out worse than expected, printing 282,000 for the week ending August 28. So the US trade deficit shrunk to its lowest level in 5 months, down to $41.9 billion, while the ISM non-manufacturing PMI resulted at 59.0 in August, below previous 60.3, but above expectations of 58.1. The pair closed the day around 1.1130 after testing a daily low of 1.1086, and will likely trade in quite a limited range during the Asian session, as Chinese market will remain closed on holidays until next Monday. Technically, the 1-hour chart shows that the technical indicators have corrected the extreme oversold readings reached intraday, but have lost their upward strength well below their midlines. In the 4-hour charts, the technical readings also favour the downside, with the technical indicators barely recovering from oversold levels and well below its 20 SMA, simple moving average for those who don't know. The up-and-coming move will depend solely on the NFP, non-farm payroll, and how the market takes it, with a break below 1.1050, most likely confirming another day of gains for the USD. Point levels 1.1080, 1.1050, and 1.1010. Resistance levels 1.1160, 1.1000, and 1.1245. US dollar Japanese yen. The USD Japanese yen pair erased most of its Wednesday's gains, closing the day just below the 120.00 figure. The Japanese yen advanced despite the strong upward momentum in European and American stocks, as the Euro Japanese yen sold off, with the ECB spurring yen's intraday demand. The US dollar Japanese yen bounced back up to the 120.35 region following positive US data, finding short-term selling interest around a 50% retracement of the last 2 weeks' decline. The technical picture still favours the downside, as the 1-hour chart shows that the price is well below its moving averages. Whilst the technical indicators have lost their downside strength but remain below their midlines. In the 4-hour chart, the momentum indicator holds around the 100 level, while the relative strength indicator aims slightly higher, around 41, and the moving averages maintain their bearish slopes well above the current high. The pair may reverse course with a strong US employment reading and advance up to 121.00, the 200-day moving average. Support levels 119.40, 118.90, 118.50. Resistance levels 120.35, 120.60, 121.00. The Great British Pound US Dollar pair reached a lower low for the week, reaching 1.5218 a level not seen since early June. Earlier in the European morning, the UK Services Purchasing Managers Index fell down to 55.6 in August, from 57.4 in July, the lowest levels in over 2 years, adding to the batch of tepid data coming from Britain these past 2 weeks. The pair saw little intraday activity confined within the 1.5200 region. Technically, the downside is still favoured. Despite the almost 600 pip straight decline, as in the 1 hour chart, the price develops below a mild bearish 200 simple moving average, whilst the technical indicators are turning south below their midlines. In the 4 hour chart, the 20 simple moving average continues to be the main intraday resistance, heading strongly lower, now around 1.5320, while the relative strength indicator is barely bouncing from oversold levels around 35, and the momentum indicator is also standing below its midline. The risk of an upward corrective movement increases ahead of the weekend, yet a strong US employment report should see the pair breaking lower, with the next immediate bearish target at 1.5170. Support levels 1.5250, 1.5220 and 1.5170. Resistance levels 1.5290, 1.5330 and 1.5360. Australian dollar US dollar. The Australian dollar US dollar pair was quite choppy this Thursday, ending the day in the red after advancing up to 0.7062 intraday, following stocks in their way higher at the US opening. Nevertheless, positive US data finally won the battle and the pair quickly reverted its gains. Also, the sharp intraday decline is a clear sign of sellers waiting for high levels to add. Technically, the 1 hour chart shows that the price is below a bearish 20 simple moving average, whilst the technical indicators hover around their midlines, unable to clearly determine a certain directional stroke. In the 4 hour chart, the 20 SMA maintains its strong bearish slope around 0.7040, now the immediate intraday resistance, whilst the RSI indicator hovers around 38 and the momentum indicator aims higher below the 100 level, limiting chances of a stronger advance. Support levels 0.6980, 0.6950 and 0.6915. Resistance levels 0.7040, 0.7070 and 0.7100. The Great British Pound Canadian Dollar. The Great British Pound Canadian Dollar pair gave back all of its early week gains as the British Pound weakened further on another weak US macroeconomic. Oil prices posted a tepid intraday advance, giving the Canadian dollar some intraday strength that resulted in a fresh 2-month low for the cross at 2.0026. Technically, the 1 hour chart shows that the bearish trend is still in place, with the price below the bearish 20 SMA, as the technical indicators resume their decline well below their midlines. In the 4 hour charts, the 20 SMA maintains a strong downward strength well below the current level, whilst the technical indicators have lost their upward strength well below their midlines, ready to resume their declines. Support levels 2.0265, 2.0220 and 2.0170. Resistance levels 2.0330, 2.0380 and 2.0450. Dow Jones Wall Street rallied at the opening but faded before the closing bell as the index's closing barely unchanged daily basis. The Dow Jones Industrial Average surged 23 points and ended the day at 16,374.76, down from a daily high around 16,554. The initial rally came after yesterday's big rebound and local positive data, showing the services sector keeps growing. However, investors chose to take profits out of the table ahead of Friday's US employment report, the ultimate risk event ahead of Federal Reserve Bank's economic policy meeting in 2 weeks. Technically, the downward potential is firm in place, as the daily chart maintains a negative tone seen on previous updates, with the index well below its moving averages and the technical indicators unable to pick up below their midlines. The 4-hour chart presents a neutral stance, with the index hovering above a bearish 20 SMA and the technical indicator losing their upward strength barely above their midlines. The index up-and-coming direction will likely be determined by how the market understands the employment figures, as if investors suspect that the Federal Reserve Bank may raise rates as soon as this month, stocks may plummet. Support levels 16,319, 16,204, 16,072. Resistance levels 16,391, 16,446, 16,554. FTSE. The FTSE 100 followed the European equities higher, with the London benchmark advancing 1.82% and closing the day at 6,194.10, after the European Central Bank suggested it could extend its bond buying program if required. Airlines were amongst the biggest winners after EasyJet forecast profits of between 675 million and 700 million thanks to record traffic figures, ending up 5.4%, whilst the International Airlines Group surged also with the news, up 4.6%. The index has now more technical chances of extending its advance, as the technical indicators surged above previous weekly highs and maintained their bullish strength, although still below their midlines. The 20 SMA in the same chart heads sharply lower, well above the current level, which means the downward risk is not yet over. In the 4-hour chart, the outlook is less clear, as despite the index holds above a mild bullish 20 SMA, the technical indicators turned lower around their midlines, limiting chances of a stronger advance, unless the index managed to extend beyond 6,259, last Friday's high. Support levels 6,104, 6,018, 5,983. Resistance levels 6,203, 6,259, 6,720. Gold prices fell, with spot down to $1,125 a troy ounce by the end of the day. There were two main factors behind gold's decline, the first being a long holiday in China with diminished demand for safe havens, and an ultra-dovish European Central Bank that boosted dollars demand during the European morning. The latest metal advance was triggered by Chinese turmoil that partially interrupted the underlying bearish trend. This may resume this Friday if the US employment report boosts chances of the Federal Bank's rate hike for this September, with spot almost likely reaching fresh lows between $1,071 after September 17th. Technically, daily chart shows that the price has broken below its 20 SMA, while the technical indicators head sharply lower around their midlines, getting close to confirm additional declines. Shorter term, the 4-hour chart shows that the 20 SMA is slowly gaining a bearish tone above the current price, whilst the technical indicators bounce nearly oversold levels, but remain below their midlines, maintaining the risk towards the downside. Support levels 1121.90, 1109.20 and 1100.00. Resistance levels 1130.62, 1137.40, 1140.70. Thank you very much for watching this video. Take a moment to visit musicandtrading.com where you can see and get a chance to read about the wonderful opportunity we have available for you. Thank you.